Your CPA just handed you a recommendation, and suddenly you're standing at a crossroads between trusting the expert and quietly wondering if you're about to pay for advice you could have Googled. We've all been there, that awkward moment where someone with letters after their name says something confidently and you nod along while internally screaming, but what does that actually cost me? Here's the thing about CPA fees. They aren't just line items. They're bets you're placing on someone else's expertise. And like any bet, the return depends entirely on what you're wagering. The average American pays somewhere between $300 and over $1,000 annually for tax preparation alone. And that number climbs fast the moment the word strategy enters the conversation. The catalyst here is complexity. As your financial life grows, so does the gap between what you know and what the tax code silently rewards. Think of it like an iceberg. Your W-2 is the tip everyone sees, but depreciation schedules, entity structures, and cost segregation studies are the frozen mass underneath that can save or sink you. Not long ago, the narrative was simple. Hire a CPA, file your return, stay out of jail, done. But now, we're in an era where proactive tax strategy is being marketed like a subscription service, and the line between genuine planning and expensive handholding has never been blurrier. There's real psychological weight in deferring to authority, especially around money and taxes, where fear of the IRS functions like a low-grade anxiety that never fully goes away. Experts like Tom Wheelwright, author of Tax-Free Wealth, argue that the right CPA doesn't cost you money, they make you money. But that's only true if the strategy actually fits your situation. History shows us that fee-based professional advice runs in cycles of trust and skepticism. Much like the markets themselves, confidence peaks, a scandal or bad outcome emerges, and suddenly everyone's a DIY accountant again. In the 1990s, tax shelters were all the rage, until the IRS cracked down hard, leaving behind a generation of investors who'd paid handsomely for strategies that evaporated overnight. Here's a pattern worth recognizing. Every generation discovers that tax optimization is one of the highest leverage financial moves available, and then slowly learns the difference between a strategist and a salesperson. The community of real estate investors, in particular, has long passed around wisdom, like your CPA should be fluent in real estate, because a generalist filing a Schedule E is not the same as someone who understands bonus depreciation, passive loss rules, and the real estate professional status. A massive misconception is that a higher fee automatically signals higher value. It doesn't. And conflating cost with competence is one of the most expensive mental shortcuts you can make. The right question isn't how much do they charge, but rather, how much more will I keep because of what they know? So how do you actually evaluate the recommendation? You run the math. If your CPA suggests a strategy that costs $2,000 in fees but saves you $8,000 in taxes, that's a 4-to-1 return, and no index fund is reliably doing that in a single year. But if the fee is $2,000 and the projected savings are speculative, contingent, or dependent on income levels you haven't hit yet, that's a different conversation entirely. The practical lesson from seasoned investors is simple. Ask your CPA to show their work not in jargon, but in actual projected dollar impact on your specific return. Disciplined evaluation means you're not buying a vibe or a credential. You're buying a documented, defensible outcome tied to your real numbers. Position sizing matters here too. Don't overinvest in advisory fees relative to the scale of your finances. Because a boutique tax strategy designed for a 7-figure portfolio applied to a $50,000 income is like using a sledgehammer to hang a picture frame. Patience also plays a role, because some strategies, like cost segregation or S-corp elections, take 1 to 3 years to fully realize their value, and bailing early because you didn't see instant results is how people leave real money on the table. At its core, evaluating any professional recommendation comes down to one discipline: separating emotion from analysis, and asking whether the logic holds up under scrutiny rather than under pressure. The CPA who gets defensive when you ask questions is telling you something important. The one who welcomes the interrogation is the one worth paying. You don't have to get it perfect. You just have to get it rational, prepare for multiple outcomes, stay flexible, and never let a fee structure make a decision that your strategy should be making. Whether the recommendation turns out to be a game changer or an overpriced non-event, the process of evaluation itself sharpens your financial instincts in ways that compound over time. And if you're ready to take those sharpened instincts and put them to work, whether that's real estate investing, home contracting, or finding the right lenders, check out our links in the description below and let's help you get started.